So my name is Hamish Lowe. I'm the head of the economics department here in Oxford. It's my huge pleasure to introduce our keynote speaker for the conference, which I'm going to do just in a minute. Before that, what I wanted to do was just to welcome you all to the conference on behalf of the department. It doesn't work. I'll do. You see, does this one work? Okay, perfect. So that was me trying to say that technology was fixed. It's always a big mistake. So I guess what I wanted to do was before I introduce Abebe, there's too many microphones now. Before I introduce Abebe, I wanted to welcome you to the Department of Economics. And the reason I wanted to do that was because with the CSAE over the last few years, the department's invested a lot in building development economics. And we've made several, what I think of as being key, excellent appointments to faculty members in the last 3 or 4 years. And we've also got a very strong PhD group. And I think that these are symptoms of how important we think development economics is. And so one of the things we've been doing with Stefan and with the CSAE is building that sense of a development community in the department and across Oxford more generally. That's why one of the reasons I wanted to be here today was really to kind of stress how important I think building development economics is, and in particular, how important it is as a core part of an economics department, as a core part of economics research. Now, I know I'm speaking to the converted, but I think it's a really important message to be getting out there. So my main job, though, is to introduce Abebe Aemro Selassie. So Abebe does graduate work at LSE, but he spent the vast bulk of his career since then at the IMF. 22 years was something more? I read 22 years and I thought, I'm not going to adjust the maths from when I thought you started. But I think it's what's clear from looking at your CV is the range of roles within the IMF that you've done. So it's not, and I think this is one of the kind of lessons I take from looking at the work the IMF does, which is it's not just one aspect. You're not going there doing one job. It's a whole range of different jobs. And you can see that in where Abebe has been working. And it's that combination of doing policy, doing operations, doing economics research. And I think this is where what we as academic economists need to be taking kind of a lesson on in terms of thinking this is the way in which economics can really be useful. I think the other side of Abebe's career is the range of countries which he has worked within or worked with. So this includes South Africa, Uganda, Ethiopia before the IMF, Ethiopia, Turkey, Portugal, and others. That range of institutional experience, I think, then informs a lot of what his subsequent work is about. And I think, again, it's this combination of understanding the specifics of countries alongside policy and of economics that's made him so successful. And I think as I said, I think that Abebe is a model of how economics can be used to have a real impact on people's lives and on countries. And so in that sense, I think it's a real pleasure for us to have you here today. So Abebe is currently director of the African department of the IMF. He's going to talk to us today about the development in the age of austerity. And I think that there's a lot of key questions there which are going to come out of this. Abebe's going to talk for about half an hour, and then Stefan's going to moderate a question and answer session after that. We're very lucky to have him here, and please join me now in giving him a very warm welcome. Thank you.
You okay?
Yeah. I hope so. I hope you can hear me. And thank you, Hamish, for that really very generous introduction. And thank you all for Stefan, everybody at the CSAE, for inviting me, for giving me this opportunity to address you all. And it's good to do so in person this time with the pandemic, for the most part, behind us. But I want to be clear that although the economic consequences of the pandemic continue to be felt really very acutely in most African countries, unlike much the rest of the world, policymakers have had limited ability to use fiscal and monetary policies to dampen its negative effects on their populations. And subsequent efforts to regain lost ground have been frustrated by the adverse external environment. As we gather here, the region is facing a brutal financing squeeze. To be sure, this is not unique to sub-Saharan African countries, but the region, of course, is the one that can least afford the implications of this squeeze, given how much higher the level of poverty remains and the remaining development gaps. In fact, my worry is that the financing challenge is one that really looks set to endure. And unfortunately, beyond the odd nod of the head here and there, this is not something that is being acted upon with the seriousness and urgency that it needs, either by the international community nor the region's policymakers. Certainly not in keeping with the profound implications for our futures. And I dare say it's not garnering much attention in the academic community either, and it's one thing that I want to challenge you to work on in the coming months and years. If I sound a bit melodramatic, it really is because an obsession of mine is believing that one way or another, this will be the African century. It is where I think much of the incremental global demand for investment and consumption will increasingly happen in the coming years, if only because the region is going to be where all incremental global population growth is going to happen. And this is a process that is well in train. If you will be patient with me in the rest of my remarks, I hope to expand on the financing challenge as I see it and how best it can be navigated. I want to start with a little bit of a discussion on how we got here. And like most great stories, this one has a classic arc that can be organized into 3 acts. Act 1 was the newish beginning that started roughly in 1990 with the end of the Cold War and went up to around 2005-06. This was a period that was, where much market-friendly economic reforms were pursued. High volumes of aid flows went to the region, and there was quite a bit of opening up of political space. And this combination of these things engendered a marked pickup in economic growth and significant improvements in development outcomes. Act 2, the price of success. I think it was Arvind Subramanian that once said that growth begets more growth. And so it was that as economic growth in the region accelerated, starting around 2005, confidence and investment opportunities increased. Debt relief from the official community, multilateral development banks certainly contributed to this. Thus, from the mid-2000 onwards, there was quite a lot of financial flows to the region, both from official and private sources, increasingly on commercial terms. From the government side in the region, the availability of increased financing made it possible to start addressing long-standing development needs. The consequence was a marked increase in the level of public debt in most countries in the region. Act 3 is when the tide went out. This started around 2015-16, and many countries were already close to the edge with elevated levels of debt vulnerabilities. But few could have anticipated the scale of the shocks that were to follow. The impact on the region's funding outlook was immediate and devastating. Spreads widened sharply, more than twice the increase associated with global financial crisis in 2008-09. Private portfolio inflows were quickly replaced by outflows. And in the face of urgent pandemic-related needs, many authorities found themselves without the finance to mount an adequate response. Indeed, in contrast to the extraordinary support, fiscal support in particular, seen across most advanced market economies, Africa's reaction to the crisis was much, much more constrained. Certainly, there was some debt relief, debt service payment relief, particularly from global bilateral official creditors of the G20, the so-called CSAE initiative. And both the IMF and the World Bank, I'm proud to say, rapidly ramped up concessional financing. Following the onset of the crisis, for example, at the fund, the amount of financing we provided in 2020-22 amounted to some $60 billion, several multiples of the financing provided in the preceding 10 years. And these resources served as an important safety net for the region. Coupled with the agile and bold measures undertaken by the region's leaders to contain the pandemic, it helped contain the greater still damage that the pandemic would otherwise have brought. But we are now also at the point where this surge in support has dried up. Forgive me if I've painted a rather linear picture to a very complex and varied developments across the region. But it is so that I, with a lot of generalization, of course, but it is so that I can get to the conjuncture quickly and also about the policy challenges and what needs to be done. So what exactly is the problem? And what is it that keeps me awake? I think, put simply, the region's most pressing economic problem right now, I think, is the funding squeeze that countries are facing. This reflects a number of factors: the loss of external market access after a brief post-pandemic respite, and indeed, capital flight is what we're seeing in many countries right now. The adverse effects of Russia's invasion of Ukraine, notably the sharp increase in food prices, the negative hits that fuel importing countries are facing at the moment, continued declines in official development assistance, much lower flows from new creditors like China and other recent sources of financing. And normally when external financing sources of financing dry up, countries can resort to, of course, the domestic markets. But this too is really rather difficult at the moment because the cost of financing domestically has gone up as countries have tightened monetary policy to counter inflation. And indeed, domestic banks are holding quite a bit of public debt. And this is not just an immediate concern, but one that can have lasting effects with implications for longer-term development. With insufficient funding, the authorities, for example, as I just noted, were less able to protect their most vulnerable and were also forced to divert resources from critical development sectors such as health, education, infrastructure, curtailing the region's growth prospects. The crisis never really passed, and the funding constraint that we're seeing now has become increasingly more problematic. Now, to be sure, we don't know how long the current funding squeeze will last. It could yet be the case that borrowing costs will attenuate and capital markets once again become more benign, allowing countries at a minimum to roll over maturities falling due in coming years. But my sense really is that the current difficult environment is likely to persist. Firstly, the global fight against inflation has been much more complicated than we hoped, and tighter financing conditions will likely be with us for some time. Second, we are moving into a more volatile world, in which larger and larger shocks seem to be arriving more and more frequently. This has clear implications for risk premia and borrowing costs, but it also means that future flows, such as official assistance, may be somewhat less reliable. The funding squeeze is all the more problematic because countries have emerged from the pandemic with elevated levels of fiscal deficits and public debt. So even if a country were to engineer a smooth return to a more normal fiscal position, the higher level of debt and higher borrowing costs mean that there will be less resources for primary or non-interest spending. What I'm really getting at here is that the difficulty that countries are facing is in sustaining current levels of per capita spending on health, education, infrastructure, much less to have the room to increase spending to help meet the SDGs. Our managing director always encourages us to hope for the best, but plan for the worst. In this vein, it is going to be very important, I think, for countries to carefully consider their funding mix. In a world where finance is cheap and easily replaced, the consequence of a particular decision can be contained. But unfortunately, we no longer live in that world. Resources have become much more scarce, more expensive. And in this world, countries have to be more cautious about the type and composition of their financing, and should be much more deliberate in mobilizing new resources. I'm going to now segue to discuss the three choices that country authorities face. To state the somewhat obvious and simplify things a bit, government's ability to address development spending needs are bounded by the amount of revenues, tax revenues that they raise, ability to supplement this by borrowing from domestic and external markets, and any aid resources, grants, concessional financing, that they have access to. Against this backdrop, and in the broadest of terms, I think there are three broad choices that a government faces, and I will lay out the trade-offs around each. First choice, I think, is around private versus public. This, of course, is an age-old and important choice that governments face about, whether to finance development spending, how much of it should be undertaken by the public sector versus the private sector. In practice, though, most African countries, and indeed elsewhere, to be honest, tend to fund, spending largely through public finance. On average, some 79% of total government spending in the region is covered by revenues, a further 19% by borrowing, and only around 2% through grants and or concessional budget support. Needless to say, these averages, of course, mask quite a bit of heterogeneity across countries. And I want to also be very precise and very clear that, the size of government, as always, is a deeply political issue and very country-specific issue. And given the important externalities involved in public spending and health, education, and the like, coupled with limited private sector capacity in most countries, government provision of such services is very appropriate. The challenge for governments, rather, is that with borrowing space limited and aid flows highly circumscribed, the only way to make more room for spending is through domestic revenue mobilization. And this is easier said than done. Take development over the last 10 years or so. Countries have done much to invest in the right areas, human capital, and improve public infrastructure. But for political and technical reasons, they have found it very difficult to capture the rates of return of this investment through their tax systems. Hence, the ratio of interest payments to debt Hence, the ratio of interest payments on debt to revenues has continued to drift upwards in country after country, with the median level doubling to 12% in just a decade, leading to the debt difficulties that we are seeing in many countries across the region. Now, in general, cross-country experience shows that countries can at most generate between 0.5% and 1% of GDP in additional revenues per year. Given the need to reduce still elevated levels of fiscal deficits to more sustainable levels in the next few years, much additional revenue mobilization in the near term is, I fear, likely to have to be devoted to reducing fiscal deficits rather than make space for incremental spending. I think among the things that this implies is that, it really is going to be very important to consider what role there may be for private finance to play in supporting development in the region, much as has been the case in Asia. At the moment, the private sector plays a somewhat limited role in development in the region. Public entities carry out 95% of infrastructure projects in the region, for example, despite there being much clear potential in this area. Africa only attracts only 2% of global FDI into into infrastructure. Further, when investment does go to Africa, it is predominantly in natural resource and extractive industries, much less so in PPP projects on roads, water, and other areas. So clearly, I think to attract more private capital flows, more attention needs to be done to improve the business environment. But this is not enough. Even in the most favorable environments, development sectors are special in a way that often complicates private sector participation. For instance, infrastructure projects often tend to have very large upfront costs, but returns accrue only over long periods of time, which can be difficult for private investors to assess. Private sector growth also thrives on networks and value chains, as we know, which not always exist in new markets. When these problems are acute, is exactly why governments need to provide extra incentives. And these can sometimes be very costly. But the truth is, many projects in development sectors simply won't happen without them. In East Asia, 90% of infrastructure projects with private participation receive some government support. Now, there are ways in which governments can maximize impact while minimizing risks and costs. For example, support could be better targeted, temporary, and granted on the basis of clear market failures. It should also be transparent and leave private parties with sufficient skin in the game, of course, and focus tightly on worthy projects that would not happen otherwise. I think with this in mind, African countries and development partners may need to increasingly consider allocating some resources towards public incentives for private projects. Underpinned by sound governance and transparency, a more innovative private sector approach may significantly increase the amount, range, and quality of services available in the region. The second choice, I think, is largely between domestic and external sources of financing. As I just noted, for the most part, countries finance themselves from domestic tax revenues. But at the margin, foreign flows, particularly borrowed resources, contribute meaningfully to government finances. And beyond just bridging the fiscal funding gap, external borrowing helps bridge the large current account deficits that are typical of early stages of development. To put it another way, external flows punch well above their weight. And in recent years, recourse to such external borrowing in sub-Saharan Africa has been very significant. For one, the global economic and financial environment has been conducive to this. And following the large debt relief associated with HIPC and MDRI, it was believed that market borrowing would help instill discipline. And with domestic savings limited and domestic financial markets of limited size, for many countries in the region, it was really the only meaningful way to raise resources needed to increase development spending. But with funding costs having increased markedly for all countries and set to remain that way, this source of funding is increasingly less likely to be an option. For example, since Russia's invasion of Ukraine and the upheaval in capital markets that it unleashed, no sub-Saharan African country has been able to issue a Eurobond. This leaves domestic savings. Of course, the need to foster more domestic savings has long been understood as the kernel of economic development. Some 70 years ago, I think it was, that Arthur Lewis noted, the central problem in the theory of economic development is to understand the process by which a community which was previously saving and investing 4 to 5% of national income, converts itself into an economy where voluntary saving is running at about 12 or 15% of national income. We cannot explain any industrial revolution until we can explain why saving increased relative to national income. There is, of course, a large and still unresolved literature that seeks to explain why some countries save more than others. Demographics, of course, seems to play a role, but there are also many other factors. by way of slight digression, Stefan was earlier asking me about the kind of issues that us in the quasi policy-making community think that going forward, PhD students should pursue. And this definitely is one of the big questions that unfortunately remains out there and not being addressed enough, of course. Now, at the IMF, with an eye to generating practical policy options, we have been paying close attention to the role of the domestic financial systems. A poorly developed system with low inclusion, ineffective regulation or supervision, of course, and limited competition, of course, is generally not good at mobilizing domestic savings and channeling those savings to people who can use them most productively. I think, moreover, the challenge in many countries in the region is particularly complicated by the fact that a large portion of economic activity is in the informal sector, where much of the population remains unbanked and where savings often take the form of non-financial assets, be it livestock, all kinds of goods and materials. These resources are not deposited in savings accounts or other formal financial channels, and so are unavailable for investment. This is why, at the fund, we have made a growing focus on financial inclusion. Not only does inclusion provide greater opportunities for some of the regions most vulnerable to save and mitigate the adverse effects of macro developments like inflation, but it can also help countries tap into an underused pool of savings, placing them in a better position to meet more of their development needs locally. But again, like revenue mobilization, this too is, of course, a very gradual process. The third choice, I think, rests between concessional versus non-concessional borrowing. Now, this, of course, is within the envelope of external financing. And concessional resources tend to be a sizable component of external flows, representing about between a quarter and a third of external flows for the region. And with few countries still able to take on significantly more debt at market rates, going forward, the need for concessional financing is more critical than ever. To my mind, Africa's progress over the past couple of decades across all development metrics has been nothing short of remarkable. Improvements in life expectancy, literacy, health outcomes, access to education have all profoundly reshaped the continent. And this was made possible by three important factors: far-reaching reforms by countries to improve public finances, the quality of institutions, and improve the business environment. Second, a highly supportive global environment, with countries benefiting, as I mentioned earlier, from growth in trading partners and ample liquidity conditions. The third factor has been much support from the international community, via debt relief initially, and subsequently significant concessional budget support, particularly until around 2009-10. More recently, of course, aid flows have been declining. But because this could be offset by non-concessional market financing, in many countries, its adverse effects were limited. However, the lower level of concessional financing is going to be felt more now as alternative sources of financing have dried up. But to note, to be clear, lower aid concessional financing, even when it declined, still had considerable direct effects, even though it was replaced by other forms of financing. Almost always, lower aid flows mean lower fiscal space. As aid flows have declined over the years and been replaced by more expensive financing, the effect has been to increase the weighted average cost of financing for countries, while making them more exposed to shifts in market sentiment. You must be wondering why I'm leaving out another important avenue, why I've so far left out another important avenue to create fiscal space in countries, which of course is debt restructuring. I wanted to get to this last as a little bit of an antidote to the rather pervasive narrative out there that the region's main challenge is too much debt, particularly to China. Yes, high indebtedness is a major problem in some countries, and debt vulnerabilities have generally increased. But in most other cases, public debt is elevated but still manageable. And yes, while China is an important creditor to some countries, in most cases, debt to China is modest. Note that public debt to China accounts for only around 8% of total sub-Saharan public debt. Hence, the problem is much broader. From a region-wide perspective, it is the funding squeeze that matters most. It threatens to push even those countries with manageable debt positions into insolvency. Now, for cases where debt is clearly unsustainable, it goes without saying that it needs to be restructured. In such cases, the burden of making repayments should not fall unduly on debtor countries. But again, this is easier said than done. Debt restructurings have always been difficult, and even more so now, in the context of a more diversified creditor base and more complex structure of public debt. Take domestic debt, which now accounts for about half of all public debt in sub-Saharan Africa. In cases where public debt is clearly unsustainable, and this exposure needs to be included in the restructuring parameter, careful consideration needs to be given to the effects on the domestic banking sector, how quickly market access can be regained. And with respect to external creditors, countries, of course, have even less sway over the pace at which restructuring can happen, as clearly shown by the ongoing challenges with the G20's common framework. This is even more frustrating in unsustainable cases where official creditors' inability to agree on needed debt treatment prevents the IMF from providing timely support to countries at a time of acute distress. A few takeaways. Forgive me if I've been a bit too glum. But my optimism about the region's prospects remains undiminished. Difficult as conditions are at the moment, I strongly believe that the vast majority of countries have reached a threshold where, even in the face of the many challenges they face, they will get by. Indeed, go on to prosper much. Rather, what is frustrating is that with a modicum of increased support, the region could be helped reach its full potential sooner, and the global economy would be a much better place for it. Of course, countries, policymakers in the region have a clear role to play. But there is something that is also, additional that's also required of the international community going forward. And these include the following. I think first, much higher volumes of counter-cyclical flows, particularly from international financial institutions, are needed to neutralize the highly pro-cyclical nature of private capital flows. At the IMF, for example, right now, our ability to sustain our high levels of support is increasingly being constrained by limited availability of concessional resources, a challenge that we're working very hard to address via pledges from our wealthier members. Second, a more agile and effective sovereign debt resolution framework is needed. The G20's common framework is an important innovation, and we would be in a much worse place without it. At the same time, it has not been able to provide the required financing assurances and debt relief in a timely manner. This needs to change, and quickly so. Again, as an institution, of course, we are working relentlessly to improve this process. Third, more support from advanced countries is needed. As one British Mandarin once put it to me, the authorizing environment for more official development assistance is not exactly favorable. Indeed, we're actually seeing significant cuts in such flows, and a significant share of what is not being cut now is being directed elsewhere. Two quick points on this. First, as I hope the preceding discussion has convinced you, this cut in aid, particularly its diversion away from country budgets, is having a very significant effect of proportionately reducing the development spending envelope. Second, if it is perhaps too much to ask for higher aid flows to the region, then one change that could at least be made is to ensure that there is much more progressivity in these aid flows to the poorest and more fragile countries. Again, absent making sure that we devote the resources needed to help build human capital and help integrate Africa into the global economy, it is not just slower growth and development progress in the region that is at stake, but a much weaker and less resilient global economy. Thank you so much for your attention.